Hi guys, welcome back. So the market just did a deeper pullback and a little bit rebound or V-shaped recovery today near the end. So far it has been moving in this range between 4480 to 4520. This is the previous rebound target I drew, and because it had passed this level, so right now it should be acting as a support. So right now I say we are at quite an important level. Definitely need to watch out for that. If it breaks, then the index would not be looking so good, but if it can get supported here, then you can just consider this a healthy pullback. But the sure thing is, 2 weeks ago, it was growing so strong, making everybody believe that it's gonna be heading into a new all-time high. But recently, it has been showing a little bit more weakness. Some people might call this forming a head and shoulder bottom and then shooting straight up to a new high. And some other people, if we zoom out, might on the opposite call this a head and shoulder top. So different opinion, completely different result. So right now we have very different perspective from different angles. The trend is not clear. And that's why recently I think it's better to take a break, take a further distance from the market, from the everyday movement, so we don't get pulled into the movement or the sentiment or the news that's flying around, good or bad news. I just choose to ignore all the news, all the noises. So recently the falling or pullback was driven by the Fed emphasizing the speed of the rising interest rates, and tapering might be faster than we expected or ever in history. So the market took a little bit dive every time someone came out to talk about something like this. But for me, I think there is nothing surprising there. But you know, the Wall Street choose to have their own way to interpret. And they chose to ignore the interest rate and tapering within the rise up, and now they suddenly care a lot about it. I say it's just a story because people are afraid that the interest might rise very fast. But if we fall for that, maybe later the news would say, you know what, the economy is slowing down and we found that rising interest rate is not necessary to be so fast. So we might slow it down. So you would think the market would grow from there, but maybe it doesn't. It's just sometimes the Wall Street want us to believe in something, a story, or connect the dots and believe that if interest rates rise slower, the market should go up. But maybe by that time, the story has already turned the other way around. So right now, the market is worried about the US rising interest rates. On the other hand, for the Hang Seng Index, so different than the US market, the Chinese government actually is doing the opposite. They are increasing the QE ever since the end of last year. So end of 2021 and beginning of this year, when the US talks about tapering and interest rate increasing, the Chinese government is doing the opposite. So that's why at the beginning of this year, when we saw US stocks were having a bigger correction, the Hang Seng Index actually were holding up really well in comparison and managed to rise a little bit even though the global markets were down. So is it gonna be the same thing this time when the US stock market correct and the HSI would continue growing like last time? For this, I would be a little bit more careful. So we know that China had been deleveraging in 2021, and near the end, they started to increase the QE to encourage more debt, more loan, more social activities to boost the economy, right? That's why near the end of last year, we saw the A-share or the HSI had a nice rebound because of this expectation of more QE bringing up more consumption and more real estate demand, more social activity, and it should help the banks and real estate and so on. So in this run-up, it was a lot driven by the rebound of some banking and real estate stocks. People were having good hope with this expectation on the news, but the real result is maybe not up to our expectation, because here it says the top real estate developers had a big decline of their sales. by 47%. And this is worse than Q1 2020. And we know that Q1 2020 was a disaster because of the COVID. Everything stopped. But this time it's worse. And it is not because of COVID, but mainly the economy showing signs of weakness. It might have something to do with the lack of demand I talked about last video, and also the debt of bond issue. In this picture, you can see the red is the new issue bond. So you can see that it was still a lot of new bond issue last year at the beginning, and then later on it became almost nothing. By now, I think a lot of the foreign institutions are being much more cautious with the Chinese developers bond. And in fact, you can see the blue are the one that is expiring quite a lot at the beginning of this year, Q1 and Q2. So we need to watch out for that, whether they can pay back on time. But here you can see the investment in real estate has significantly slowed down. This is the performance of the major developers this year. Basically, a lot of decrease by averagely 30 to 50%. This is the speed of real estate investment. You can see it's falling quite fast. And this is the sales number in terms of the size and revenue. And this is an indicator for the well-being of the Chinese developers. So a lot of data have pointed to the same result, that right now there is a clear slowdown in the real estate sector. And because this is one of the main engines driving the Chinese economy before, it would spread out to other social activities, such as people's consumption, their debt, their loan, the margin, and affect the business for banks and other giants. Even the internet giants right now, you can see a big wave of firing, such as Alibaba. They say it's driven by the crackdown of the government, the tension between US and China, and COVID. But I think it's also the side effect of the education sector that's been going down, and also the lack of demand because of the real estate, lack of consumption. So it should affect the giants like Alibaba, JD, because it would reduce margin, reduce social activities. So my point is, unlike last time, that investors had the expectation that the QE would boost the economy. This time we are seeing that the QE is not really helping much, or at least right now the data is showing that the QE doesn't help. So this is something we need to keep in mind for. Right now I think the HSI is heavily controlled, heavily manipulated. For the past 2-3 weeks it has been consolidating after the rebound and might choose a direction to break out. Last Friday and Monday, it had a big turnaround, so people were getting quite bullish. But on the Discord, I pointed out that last Friday, when both the US dollar index and HSI were running up, it just didn't make much sense because they should be working on the opposite direction. They should not be running up together. So something is wrong and one of them needs to come down. And I also thought the rise of the US dollar index is not over yet. My target for the short to medium term would be, as I said last time, 101, similar level as the rally with COVID. So for this, I expect some bad news to come out of nowhere. I didn't know what it is last week, and now we know it's the war that's not ending anytime soon, and also the rising interest and extra fast tapering. There might be more coming because I think the US dollar index still have room to grow. And as we see the past 2-3 days, the US dollars continue rising up very strong, and the HSI had corrected the divergence and pulled back from 226 to 215, the lowest of today. So more than 1,000 points drop, which just proved that these 2 days run up were heavily controlled by the institutions, because I pointed out last week as well. You can see the significant shrink of volume on these 2 days it ran up. So I thought it was controlled by some certain institutions. And the Chinese funds were off for holiday, so it should be more controlled by the foreign institutions. If they want to run up, is to show something or give out hope or a bull trap, or to kill the last short positions before pulling back. Anyways, my point is that this time, unlike back in January, the QE news or the stimulus from the Chinese government may not work as well as last time. So we need to be more careful and filter out the news we're hearing and watch out for the slowing down of the demand. It might have some short-term rebound, but if you're bullish and you want to buy the dip, I would still suggest to do it slowly. Add on the bad news, trim on the good news, and don't go heavy all at once. You still have time. If the US dollars index continue running up, watch out for black swan news coming out of somewhere in the world. Because US dollar running up is not good for emerging market. The smart money would pull out their capital and move to US. So it's not good for emerging market and the risk on stocks like the growth stocks, the tech stocks. And also something to point out for is NIO and Xiaopeng. Recently, I see that they have been somehow compressed. So maybe the short sellers have been setting up the short positions again. It has been consolidating for 2-3 weeks. So if it breaks out, it might be pretty strong. And I will be careful if it breaks out on the downside. But for this, you can monitor the movement of BYD. You can see them as the leader of the EV sector, the Chinese EVs, and also has no risk of delisting or the VIE structure. I thought it should grow more than the other EVs. And you can see it continue making higher highs and higher lows. So I hope BYD can lead the other Chinese EVs to grow more to follow the move. So right now BYD is at a strong support of around 232. If it continue holding, it can keep running up and might lead the others. But if it gets rejected, then I'll be more careful for the other smaller ones. Keep an eye on this. For NIO, since the bottom of 13 to the highest of this rebound to be 24, we can see that the 61% retracement should be at 19.7 on this range. And today the lowest, it got to 19.7 exactly. So if it can hold, I expect some rebound from here. But after that, it might retrace to the next level, which is 18.5. That might be another point to catch a rebound. So this week's plan was to buy in the dip for BABA at 108 to 110 and then second support at 102. So on Tuesday, you can see BABA had broken the 108 support. And today it got to 102, the lowest for next support. And within this rebound, the 50% retracement is 98. So I would say it's the extreme pullback. And if it breaks that, it might go lower for a second leg. And the Baidu put option to buy at 152 and the first target was 136. And you can see on Monday, Baidu grew to slightly above 152 and today it also reached slightly below the first short target for 136. SOXS was the most crazy one, suggested to buy between 36 to 38, and it grew from the Monday of 37 to the high of 48.5 today, so 30% up. Because the chip sector took the most hit, it was leading the Nasdaq to go down for the short of demand. Now that's it for today, and if you have enjoyed this video, please give me a big like and write me a great comment, and I'll see you in my next video. That's it guys, hope you can find my videos helpful. Make sure you subscribe to my channel and give me a big like. Thank you.